Hi, everyone. How are you? Hope you're all doing great. We're going to start in just a couple minutes. Let everybody join the webinar. I see already people are raising their hands. Good to know you have a question right away. We're going to start with a couple questions of our own, and then we're going to ask you to submit questions via the Q&A, but just give us a second, and we'll let everybody join. Welcome to all of you. Thank you so much for being here. The questions are going to go in the Q&A section. So if you have some already, you can put them there now. Nice to know you've all come armed with all the questions that you have. Put them in the Q&A. We're going to start in just a minute. I'd like to give everybody a minute to get started and join us. I hope you all had a really nice day, or are in the midst of a really nice day. It was actually a little bit cooler here in New York, where Stash has the headquarters and where I'm sitting right now. So that was a nice reprieve from the summer heat, but I hope you're all enjoying a wonderful summer, a How to Money summer, if I may. It's our How to Money summer series. This is the second webinar. Really excited to have you here. Thanks to everybody for joining us. In just 1 minute, we're going to get started. Welcome to all of you. Thank you for being here. You can see Doug. Hi, Doug. I'll just give everybody 1 more minute. Welcome. Pull up a chair, get comfortable. We should have a really good 45 minutes or so to share some money advice live. Just 1 minute. When it turns 7:02, we will get started. All right. Look, 7:02. All right. Hi, everyone. Thank you for coming to our webinar today, which is part of our How to Money summer campaign in our summer series. 3 months worth of webinars and activities that will help you hit your money goals. Plus a sweepstakes where you can win $150 for turning on AutoStash for 3 months and attending and registering for a webinar. So everyone here, you're already well on your way to eligibility. Again, just go into your app, you turn on AutoStash, just click Manage AutoStash. It can be just a couple dollars a month that you're setting aside for 3 consecutive months, and you'll be qualified for our sweepstakes. I'm Sarah Spagnolo, Sarah from Stash. I'm the one that you got the emails from. I'm the managing editor here. Thank you so much again for coming this evening or afternoon, wherever you are. Money advice, right? That's the topic. That's what we're all here for. My dad was always such a big help to me when it came to money. Sadly, he's been gone 10 years this fall. And what can I say? I'm always looking for a little extra advice so that I can do my best to make good decisions for myself, for my kids, and for my family. And that's even more pressing today, right? Am I right? With everything that's happening in the world, sometimes we just need a calming soul, an expert to help demystify the burning questions we have and give us some good old-fashioned advice. Well, great news. I've invited Doug Feldman, Stash's Chief Investment Officer, to join us today and answer all the questions you might have. Doug is Stash's Chief Investment Officer. He oversees our investment strategy and recommendations, and he leads the team that provides key market commentary, education, and financial advice. He's been in this world for decades. He's helped to advise millionaires and fancy people with lots of money. He really, truly knows his stuff. And lucky enough for every Stasher and for all of you, you can get access to him too. He's the one here tonight and the one that picks the investments in our managed account called Smart Portfolio. He oversees our content. He helps us create value for subscribers like you every day. Throughout his 3-decade-year career, Doug has extensive experience making direct investments in both the public and private markets, allocating money across a broad range of asset classes, and providing strategic advice to companies in various industries. He's worked for some of the best firms out there, went to Wharton, Harvard. He's the real deal, and I'm pleased to call him a friend and trusted colleague too. So Doug, thank you for being here. And now I'm going to hit you with some questions. Some of these questions are mine, and some of the questions are taken straight from Stash customers. I'll ask about 10 of them, and then we'll open it up to all of you. As a reminder, you're going to use the Q&A at the bottom of your screen. We have people moderating the questions. Some of them we're going to try to answer in real time. So with that, Doug, welcome. I'm about to get started. How are you?
Doing great, Sarah. Thanks as always for the warm intro and welcome everyone. Looks like we have a bunch of attendees here tonight, so welcome all you Stashers. It's always good to be able to talk to you.
I agree. I've been excited about this webinar all day. Okay, Doug, first up, tell us, what's the state of the stock market so far this year?
So, for all of you out there keeping track, we are having another banner year in the stock market. The S&P 500, which is the index that tracks the largest 500 U.S. public companies, has continues to break records. It's still near its record highs, despite some pullback this week. The S&P 500 is up about 16%, I think a little bit more than 16%. So far this year, and it's set an all-time high. I think it was, I just saw a stat, it was like over 40 times so far this year. So while the index has been really strong, one thing to note is that it's really been a tale of two stories, where a lot of the growth in the market and strength in the market has been in some very large tech companies like NVIDIA and Apple and Microsoft. For example, NVIDIA is up roughly 140% this year, and it's been one of the major drivers of the overall index. So while tech companies have shown a lot of strength, one concern that investors have has been the rest of the market. And many companies, especially the smaller companies, medium-sized companies, maybe industrial companies, they hadn't been performing as well as the index had. And while this is going to be a broad generalization that I'm going to give you here, the reason the strength in this market has been really concentrated in the mega cap tech sector, and not more broadly has been overwhelming concerns over the economy, the direction of the economy, over inflation, which I know all of us are sitting here on this call tonight are seeing it in our wallets and pocketbooks when we go to the supermarket stores, and high interest rates, which may be impacting your mortgage payment, your credit card loans, your auto payments, all of that type of stuff. So that's been weighing on a lot of the space despite the strength in the tech sector.
So that's really fascinating to talk about the tale of the two stories here. There's been a lot happening this week that feels a bit different. Maybe some people have read that people are saying the market is pulling back. Can you explain what that means and also why maybe that's been happening?
Absolutely, and it's great. Well, great or not so great that we're doing this evening, because yesterday we saw the Nasdaq, which is an index that covers the tech stocks, down a lot. The market was down today as well, and so what really has happened over the last couple of weeks, the Fed, which controls interest rates, has begun to indicate that inflation may be under control, which is a good thing, and they are ready to cut interest rates. So as a reminder for everyone on this call, because this gets a little complicated, but the Fed uses interest rates to control, let's call it the speed of the economy. And they'll raise interest rates to slow the economy down and to reduce prices if inflation's going high. And they'll lower rates to fuel spending, thus speeding the economy, but potentially, having an issue with inflation. So when the Fed, coming into this year, investors were enthusiastic about a potential rate cut from the Fed. They delayed, but a couple of weeks ago, they started hinting that they would begin to cut rates maybe as soon as September. And while this is something investors were hoping for, we've begun to start noticing some sector rotation. And sector rotation is when investors sell stocks in one industry to buy stocks in another. And what we're beginning to witness is investors selling off some of these larger tech names, these mega tech stocks I was talking about, were the main driver of the market's performance, and buying some of the smaller companies or industrial firms that may benefit from the lower rates. And they're also, additionally, over the last couple of weeks, investors are beginning to price in the potential, the prospects of Trump winning the election. That's starting to look like that may happen now, and how that will impact various sectors and companies. And so we're starting to see this rotation happening.
Thanks. That's a good lead into the next question. And again, to remind everybody, if you have your own questions, put them in the Q&A down at the bottom. But how will the election impact the markets and the economy?
So we're still a few months out from the election, and while I mentioned, looks like as of sitting here today on July 18th that Trump is favored to win the election, anything could happen between now and November, and it's a ways out. And I know many investors are always wondering how is upcoming election going to impact the markets and what they should do or not do in anticipation of that. So the short answer is that elections can cause short-term market volatility, but they generally have a minimal long-term impact on overall market performance. And really, what's more important is over the longer periods of time, the stock market tends to follow broader economic trends rather than outcomes of specific elections. And there was a research study put out by US Bank recently that just went through this, and I was reading through, and I was going to give a lot of data on it, but I decided that I'll summarize it for you here, which is that, really it doesn't make a difference. In the short term, you may have some swings, but the gains or the losses are generally modest. But what they did find is that over the longer period of time, individual sectors and industries saw differences, and that's really based on the approaches of the administration. That's why we always, stress a diversified approach. And so if you look at, the two most recent administrations, look at Trump from 2016 to 2020 and Biden from 2020 to now. The market has been on a tail under both those administrations. And, as an outsider looking in, well, they're very different, politically very different regulations, very different approaches to things. But the stock market has performed very well in both of those. And so that really shows that while policies can differ, the overall market is influenced by a multitude of factors. And while we see these, short-term fluctuations, the change in administration or not can lead to shifts in regulatory policy. So, for example, a second Trump administration might focus on deregulation in sectors like energy or financials or healthcare, while a continuation of the Biden administration might maintain or increase regulatory oversight in such areas as environmental standards or consumer protection. Trump is talking about reducing taxes at the individual level and at corporate level, offset by higher tariffs. Biden's approach would probably be higher taxation. All of these things impact sectors and market as a whole. And so the real takeaway here is that these things typically unfold over time. The market, maybe over the last couple of weeks, is starting to price in that Trump will be in, and for whatever reason, the sector rotation is starting to happen now. But really trying to guess how the market's going to respond in the short term to these movements is usually a losing game. You should really be thinking about this over the long term.
Thanks. That's a great answer. And I want to call out a question from Sean, who asked, how much attention to macroeconomics should a young ETF investor spend time on? Because I think that's going to lead us to a lot of the personal finance questions that we have coming next. But before I do that, what I'd like to do is take a quick poll, if we can, which is whether or not you want to know more about how the election will impact the markets. That will help us determine some content going forward. So thank you to everyone who's quickly voting. Hundreds of answers real fast. I'm going to take this down in 1 second, and we're going to move more into some personal finance questions, which I see most people are sending our way. So I'll give it just like 2 more seconds. If you've answered, more people than not are interested. Good to know. And then at 5, 4, 3, 2, 1, end. Okay, great. Thank you for that. Okay, I'm going to move into some of the personal finance questions that some of you are asking. So let's start with Stephen's question, which is related to one of the questions that we had from before. The question that I had prepared, which was, I have a goal of $1,000 in mind. What's the best way to get there? And the question, I think we'll start here. Maybe I said Stephen. I'm going to start with Blaine's question, which is, I've never invested in the market. How should I begin?
Okay, so we're starting Blaine's question. Hi, Blaine. How are you? Never invested before, and how should you begin? I think it's a great thing, and it's a really I'm thrilled to hear that you're just starting on your journey, because I think a lot of us and a lot of the other people on this call probably are new to investing as well. That's what typically a lot of stashers are. So at Stash, we focus on really trying to build wealth over the long term. And we have what we call a thing called the Stash Way. And the Stash Way is our approach to making money. It's tried and true. And it really is based on three separate pillars. And the first one is to really maintain a long-term focus, not to get caught up in I mentioned this a little bit a while ago, not to really time the market. We say often here it's about time in the market versus timing the market. So that's one of the three pillars. The second pillar is to always invest in a diversified manner. We do not believe, you probably when you were in kindergarten or nursery school, you heard a little thing, don't put all your eggs in one basket. Well, it's true. You don't want to put overly risk. And we talk a lot about diversify. And diversify means investing across various asset classes such as stocks or bonds, and investing across various industries and size of companies and geographies, to really diversify so that you're not overly exposed to one thing, but you get broad exposure to everything. And then the third pillar is regular investing. And so, Blaine, the best way to start, what I always recommend to everyone that is new to investing and to start off, is really to look at, you have access to our smart portfolios, which is our managed portfolios, which is a way through that Stash will for you manage it. We will put your money into a mix of ETFs that will give you broad exposure, as I talked about diversification before. That'll be managed to your risk profile based on questions that you answered during onboarding. It's a great way to work to build wealth over time without taking on tremendous risk. And if you do that with putting away whatever it is that you could afford to on a regular basis, a lot of people try to time it with your paycheck. If you get paid weekly or every 2 weeks or monthly, to put a little bit away each time and do it. Like, I'm a big believer in that sort of approach. If you want to choose your own adventure, sort of, and you like, picking, we have a lot of tools on the platform to help you, but always, I'm a big believer in ETFs. ETFs are like baskets that own a lot of things. They're low cost and they enable you to reduce risk, yet get exposure to everything.
So Doug, connected to that is, if you were to have a goal of $1,000 in mind, what's the best way to get there?
That's a good thing. So, a lot of people, for many, and probably for many on this call, having even $1,000 access to that seems like a daunting prospect. For others on this call, $1,000 may be your excess money each month or whatever. So, but for $1,000, while that number may seem large and daunting, think about it this way. It's a few dollars a day. A few dollars a day or $20 a week over the course of 1 year, that's $1,000. So the question is can you find $20 extra a week to put away and to start investing in your future? And if you could do that, in a year's time, and you will have $1,000, and with compounding, will work on it. And compounding, by the way, is what happens with investing is you invest, it hopefully earns a little money. And then over time, that money that you earn money on will earn more money. So you're earning money on it on top of each other, on top of itself. So it's a great way to help boost your returns.
That's related to the question from Anonymous, who said, what's a good amount of money to set aside to get some substantial savings going, which is whatever you can, of course. But if you are to put aside what you were suggesting, Doug, about $20 a week, then you can get to $1,000 within a year.
Yeah, and I think and so Anonymous, it's a great question. And listen, this is very specific for a lot of, and it's very different for a lot of people, but I'll give you a couple of rules of thumb to think about. And Anonymous, again, I don't know who Anonymous is, so I don't know your personal situation. I can't really tell you. But when we think about the hierarchy of things that you could do, and if you were on the webinar, I think it was a month or so ago, where we talked about emergency savings. the first thing that we love to see is to get everyone to the point where they have liquidity. So that means that if you go out and you're driving your car and you break a tire and you need to get a tire immediately and you need access to a few $100 or $500 or $1,000, you have that. And that should be money that you're putting away in a bank where you have access with an ATM card. After that, we like to see people have what we would call a safety net or a cushion, which is in the event of a longer term emergency, something you unfortunately lose your job or you're sick or something along those lines, where you would maybe put away 3 to 6 months worth of your income, in a safe manner where you're not going to lose it. Maybe you could earn a little interest on it. After that, a great rule of thumb would be to think about taking 20% of your after-tax income and saving that each year, or saving or investing. Sometimes that may be a daunting number for certain people, but as a target, if you could do that, whether that be through retirement savings through your employer or an IRA or into a smart portfolio or even into whatever it is, you're investing in yourself and you're taking a little bit and you're paying yourself first. That's a great, like, if you could get to that level, that's a tremendous, bogey to hit. So that may be, for some people, that may be $20 a month, that may be $100 a month, that may be $1,000 a month. So it's going to be very different. But if you could try to think about $20 of your after-tax income being saved each month or each year, that would be a really good goal to try to achieve.
So Joel, hopefully that answered your question too. How much of your monthly expense should you be saving? All right, let's go back to some of our questions that we had gotten before this. Doug, here's a good one. How do I research a stock?
Oh, that's a great question. I love this question, and I get it all asked a lot by people, but they ask me a different way. They say, "Hey, should I buy XYZ Corp or ABC or whatever it is they want to do?" And so when people ask me this, I'm the king of not saying yes or no. But what I do instead is I guide them to try to understand, well, why are they interested? Why are you interested in XYZ to begin with? Why? And then I always suggest to do their homework, what I call homework, but that's really research, before making any investment decision. And what does it mean to do research on a stock? So for everyone, this may sound like a lot, but there's a reason for it. And that is that I suggest that everyone look at the key financial metrics and reports of a company. Most public companies have investor relations websites now. You could go on that. You can find they're required to publish quarterly reports with the SEC that contain financial information. I would review those. I would understand the company's health. I'd analyze some metrics. I mean, there are various metrics you can look at, whether or not that's profitability or revenue growth or their debt to equity ratio. You could valuation metrics like P ratios. All this stuff may sound like gobbledygook to a lot of you, but trust me, there are people out there that are doing this, and you should be reading recent news and press releases and understanding what analysts are saying and focusing on the markets. All this to say is that thoroughly researching an investment it requires significant effort, and professional investors. And so before this, I used to work in the hedge fund space. I managed a portfolio of billions of dollars. The amount of time I would spend with any individual company, I'd be researching them for not like minutes or hours, but like weeks or months or even years before making an investment at some point in time. And you follow them and you know them. And so the issue, and not to dissuade anyone from investing in individual stock, but that's what professional investors are doing. They're really spending the time. So while I would never dissuade anyone from making an investment in an individual company that you've researched and that you love, one of the things that we recommend at Stash is to keep your investments in any individual company to less than 2% of your overall portfolio, 2% being a rule of thumb, because that's a way to mitigate risk. It allows you to buy a collection of different stocks, get exposure to diversification without doing that. And probably it's also interesting to know. So when you think about stock prices, for example, I'm going to use Microsoft. Microsoft is $440 at close at roughly today, so $440 a share. Just so you know, through Stash, you don't need to come up with $440 to buy Microsoft. We have a thing called fractional shares. So you could buy any dollar amount and still own Microsoft. So you want to buy $1 worth of Microsoft, you can. You could get exposure without doing it. But which is a great way. So don't be frightened by the share price itself and think you have to come up with that much money to get exposure. You can do it through fractional shares. But the other way to think about it is that we are very, very, very big believers here at Stash in low-cost ETFs. Now, ETFs I know that's acronyms don't work for everyone, but it's an exchange trade fund. But think about it as a basket. It's one investment that holds lots of different investments. So you could buy an ETF that will give you exposure broadly to the stock market or any individual sector. So if you're looking at XYZ stock, instead of doing the research on XYZ, maybe you say, yeah, I want that, but I want exposure. I'm just going to buy an ETF. It'll give me some XYZ along with ABC and DEF and GHI and all of that. And over the long term, I'm getting exposure to lots of different companies, and including the one that you might be interested in.
And Doug, maybe you want to tell people I'll tell them because about how we've removed the jargon from the ETFs that are on Stash. So it should be really easy for you to find, whether it's companies run by women called Women Who Lead, or other types of baskets of ETFs where we've given it a very specific, straightforward name intentionally to help everybody feel more comfortable taking advantage of those ETFs. All right, Doug, we have lots of questions and you have really amazing, thorough answers, but sometimes they're long. So a reminder that we got to get to some other things. All right, Felicia is saying, I paused my auto stash while I pay off some credit card debt I got into. Is this a mistake?
Hey, Felicia, thank you. Hold on. Thank you for the question, Felicia. And I think one of the most important things to do, and credit card debt is something that many Americans are challenged with. And credit card debt is difficult because the interest rate on not paying it down could be extraordinarily high. I mean, you could be paying 25, 30, 35+% on your credit card. And it's hard to have your money work for you and get out of that. I know that's a big hole. And so I applaud you for making the effort to actually pay that down, which is great. No, it's not a bad thing to pause your auto stash to pay off your credit card debt. I mean, credit card debt, that's one of the things you want to try to knock out and get out of the way, because otherwise you have a big hole that's just going to get bigger over time, unfortunately, if it's not managed. So pausing your auto stash, pausing your investments to do that, you typically would make sense.
All right, two related questions for you. One from Jessica, Rebecca. Jessica asks, how do I keep FOMO from stopping me selling? And Rebecca asks the inverse of this, which is, I haven't moved or changed any of my investments. I just let them be. Is this best, or should I be more active?
Okay, I apologize. It was Jessica and
Rebecca.
Rebecca. Hi, Jessica and Rebecca. Great questions. So Jessica talked about fear of missing out, right, and fears and anxieties of the emotional aspect. And Rebecca is asking about, maybe not making as many changes to to their portfolios as maybe would be interested in. So, yeah, I mean, Jessica, the question about fear of missing out is a good one. And investor psychology is something that we focus a lot on here, because the worst thing one can do, maybe not the worst thing, but a bad thing to do would be an emotional investment, or making decisions emotionally rather than analytically. And we have a lot of tools to try to take the emotion out of the business. And that's why I always go back to that stash way and one of the pillars of just regular investing and diversified investing, because through doing that, you take away the emotions. Like the idea of there's a good chart here of like dollar cost averaging and buying, regularly, like you just do it over time and you get exposure, prices go up, prices go down. If you want to buy something for the long term, you do it on a regular basis. The market is going to move around, but you're never stuck having to make an emotional choice of something. Rebecca asked a question, does it make sense to be more active in a portfolio? Also a great question. Active is usually bad. The more active you are, the more decisions you make, the more chances you have to make a mistake. Now, ideally, the truth of the matter is, look, I'm a professional investor. I've been a professional investor forever. I will tell you, the single best investment I've ever made was in my children who are in college now. When they were young, I opened up 529s for them. I put money in once a year. I put it in, it got allocated, and they never touched it. Never touched it. And lo and behold, 20 years later, the money just has grown because each year I put in a little bit and it's grown and it's grown and it's grown. And I never touched it and never made an emotional decision. I said, this is being invested for their college education. And lo and behold, their college educations are being paid for. Fantastic, right? That's a great successful outcome. Rebecca, it's not about being active that's important. It does make sense, though, to do a check-in every once in a while, maybe every few months, just make sure that nothing has moved around. Now, in your smart portfolios, which Stash manages for you, we take care of that for you. That's why it's a really, for certain people, and for some people on this call, it's a great outcome because you put into regular investing. We take care of it for you. We make sure it's being rebalanced. There are no extra fees or anything associated with that, and it just gets invested and it's always done. If you're doing it in yourself with your personal portfolio, check out, we have a tool called diversification analysis, which is a tool will give you recommendations for where you're underweight or overweight and some things that you might want to consider doing. But if you're checking in on it once every 3, 4, 5 months, something like that, these aren't things that you need to be changing actively.
Randy's asking, not Randy, sorry, Michael's asking, what's the rule of thumb on how long to hold a stock? I think you sort of answered that here, which is, it depends.
So, Mike, that's another great question, and something I also get asked a lot, and maybe it's like, if you don't mind, sorry, I'm going to give an example. Like, people always ask me because NVIDIA, great stock, and it's up a lot. It's up a lot over the last year. And I have lots of people that I know that ask me, hey, what should I do with this stock? It's up, in 2023, the stock was up, I think it was 240%, and it's up another 140% in the first 7 months of this year, whatever it is, 6.5 months of this year. And that's been driven by, in case for anyone out there that doesn't know, NVIDIA is one of the largest companies in the US. They design chips, computer chips that go into, right now, that is fueling the big AI or artificial intelligence boom that's going on. And so they've gone. So I don't have a magic 8 ball, and I can't tell you what NVIDIA stock will do going forward, but I could give you some guidelines, Mike, that will help you in determining any stock that you own, and I don't know which one it was, but so when you buy an individual stock, you should always have a price target in mind. So let's say the share price for the stock today is $10 a share, and you think that over the next 5 years that it could achieve $20 a year. So you have a target price of $20 based on the research you've done and the thought process in there. So now, unless something changes for the company or the industry or the market, and things do change all the time, that price target usually should be, well, it was $20 going in. I want to see it get to close to $20. So typically when a stock starts approaching that target, it's always a good time to reassess if you should continue to hold or sell, or if, something's, and clearly if something has changed, like the market changes, they introduce a new product to launch, where there's a new competitor, whatever it is, maybe you have to adjust that $20 target. But as it approaches your target, you should always be reevaluating it. And you should also always be considering in the context of your overall investment portfolio. And I think, on this call, I spoke a little bit earlier about individual stocks and how at Stash, we like to suggest that people keep it to no more than 2% of your overall portfolio. Again, reason being is that mitigates risks, right? So if one of your holdings, if the stock you have is, let's say you bought it and you bought it as 2% of your position, and now all of a sudden it's up a lot, like Nvidia is up and it's 5% or 8% or 10% of your overall portfolio. Well, you may want to consider, even if it hasn't reached necessarily your target price at that point in time, is it too much of your overall portfolio and do you have too much exposure to it? So unfortunately, like Mike, I don't know your exact stock you're talking about, and even if I did, I wouldn't be able to necessarily, say if you should buy or sell or hold or what you should do with it. But I think more importantly is hopefully those thoughts can help guide some of that decision process for you.
Thanks for that framework, Doug. One of our final questions, and then we're going to move into a little bit of research for Stash as we close it up. But here's a good one. I like Berkshire Hathaway and want to know about other similar companies to consider.
Good. Awesome question. Berkshire Hathaway. Great question. Okay. So for everyone out there that doesn't know, Berkshire Hathaway is one of the largest conglomerates in the world. I think has a market cap of about $1 trillion right now, and it's one of the top 10 largest public companies in the U.S. It's probably like five, I don't know, 7, 6, 7, something like that, right behind the big tech giants. Berkshire Hathaway, again, for those of you who don't know, it's a holding company, and it's run by Warren Buffett. If you don't know Warren Buffett, worth a little Google and just explore who he is, but he's considered one of, if not the greatest investor of all time. He has a nickname, the Oracle of Omaha, because he's from Omaha, Nebraska, and he's considered a guru of value investing and investing. And so Berkshire Hathaway is a holding company or conglomerate. It owns lots of things. It owns many private companies, names that you would have heard of. Geico, Duracell, the paint, Benjamin Moore. It has large holdings in many public companies. I know like Apple's a huge holding of it, Bank of America, Coca-Cola, Amex, big companies. It truly is a special company. Warren Buffett truly is a special individual. In fact, so Sarah, just so you know, and everyone is called, when we launched Stash in 2015, we launched with it was like 22 or 23 ETFs on the platform and one stock. And the only stock we offered we started with was Berkshire Hathaway. So unfortunately, I don't know who asked this question. There aren't a lot of other companies like Berkshire Hathaway out there. It really is a special thing, and there aren't many extremely large, well-diversified holding companies run by someone of Warren Buffett, etc. That being said, I would liken in a way Berkshire Hathaway is somewhat similar to an ETF. In that an ETF, and again, I use this vernacular early on, exchange traded fund. Think about it. I said that was before. It was like a basket that holds lots of little investments. So, Berkshire Hathaway, it's a holding company where you're investing in one security, but it gives you exposure to many different industries. And so while Berkshire has like the exposure to or the risks or exposure to Warren Buffett's decision making, the underlying holdings are acting like a diverse snapshot of the economy. And so you could theoretically, I guess, you could invest in a diversified ETF, which would also give you a mix of companies, help spread risks a similar way, and give you similar types of, exposures over time.
Awesome. Thanks for that. We're
Absolutely.
going to move into our next segment here for a second, but I did want to respond to someone who asked if we're going to be doing webinars on more advanced topics, and the answer to that is yes. So please stay tuned for webinars tackling more advanced topics. And also I want to pass on some nice words to you, Doug, from Tiffany, who says, not a question, but I wanted Doug to know that I'm really happy with the work he's doing on my smart portfolio. That's our managed account. It's doing so well, and I look at it whenever I'm having a bad day.
Oh, Tiffany, I want you to know, Tiffany, that thank you. Thank you. That's excellent. That's really great to hear. And in terms of Sarah, in terms of more intensive topics, like ask. That's a great,
So,
we should,
so
let's hear what people want to hear about, and we will figure out ways to do it.
Exactly. That's what our next section is for. I'm going to switch gears and we're going to talk about investing on a tight budget, but I'm going to ask you some questions. And in the Q&A, we record everything, by the way. We're going to get back to as many people as possible, either individually or within other webinar topics. So please feel free to talk to us through the Q&A. You've all prioritized your financial well-being, and that's why you're here. We're here to help people like you save and invest. And we want to better understand some of the challenges that you have. And, for many people, the biggest hurdle, and we've heard it today, is that many people feel like they don't have enough money to get started. So the first question in the poll I'm going to share is, do you ever feel like you don't have enough money to invest? And if so, what are the main reasons that drive that feeling? So let me give you where is the poll button? Hold on, I had it earlier. 1 second. Here we go. Polls. I'm going to give you this next poll. Here we go. Ever feel like you don't have enough money to invest? What are the main reasons that drive that feeling? Here we go. I'm going to give you just a couple, maybe a minute to answer this question. This is going to help inform some of what we do, both in the product and in our webinars and in upcoming content. So really do appreciate you giving us some information. A lot of you are saying, I keep getting hit with unexpected expenses. I feel that, God, that's always so hard to manage. And just like a
And
part of
especially
life.
with that higher inflation these days, and like everyone's budgets, we know this. We hear it all the time about how budgets are so strapped now versus where they might have been pre-COVID, and it's not.
Absolutely. All right, hundreds of you have responded. I'm going to give it 10 more seconds, and then we're going to move on to our Q&A where there's a fill-in. So you're going to use your Q&A tool. All right, thank you to everyone. I'm going to count us down. 5, 4, 3, 2, 1. All right, the answer here. What's the main reason that drives that feeling of not being able to invest? I keep getting hit with unexpected expenses. All right, thank you for that. The second question is a fill-in. So I don't have any poll that's going to pop up, but please write in the answer. What has been the one thing you've done that's helped you to invest when you're on a tight budget? Open our Q&A and see if I can pull up some of your answers. Maybe your answers can help to AutoStash. Chris, thank you. AutoStash, another one. That's what's helping people invest on a tight budget. Started using Stash Pay Myself First, AutoStash. Look at all of you auto-stashing. That means, by the way, if you're auto-stashing and you're here, that you are entered into our How to Money Summer Sweepstakes. So AutoStash, auto-invest. The AutoStash of even $5 a week has been super helpful. Well, listen, I mean, like I wouldn't have expected you all to say Stash, but thank you. No Starbucks. That won't work. All right, investing small amounts, keeping a spreadsheet of all my expenses. I do that. I keep a spreadsheet of everything. It really helps me. All right, make investing like a bill and invest automatically. Wow. Doing a little bit each time I can. It worked out well. I keep it coming. Everyone, thank you so much for that input. We're going to share these insights with you in the future, plus lots of more guidance on investing in a tight budget. With that, I'm gonna close us out. There's so many amazing questions here. I wish we could have gotten to all of them, but good news, we do these webinars frequently, and we're going to do them more and more frequently, and we're going to figure out a way to answer all of your questions to the best of our ability. So I'm going to pull up our end screen, which has the required disclaimers. as we are a registered investment advisor, so we have to be really clear about that. Thank you to everyone who joined us for this webinar as part of our How to Money Summer campaign. The information we shared today is purely educational. We're not providing any financial, legal, tax, or investment advice. As a reminder, everyone who registers for at least one webinar and turns on Auto Stash, just go into your app and turn on Manage Auto Stash, or already has it turned on, and automatically invest in yourselves for 3 consecutive months is entered to win $150. Our next webinar is Thursday, August 8th, with our Stash co-founder, Brandon Krieg, where he'll talk to us about his journey to success, lessons learned, and how to be smart about money. So be sure to register and join us. I want to thank you all for coming. I hope you have a wonderful evening and a relaxing night and journey into the weekend. Starting tomorrow, it's Friday. I want to thank you for spending a little bit of your summer with us and participating in the Stash How to Money Summer. I want to thank Doug. Doug, thank you as always.
Thank you, and thank everyone for attending tonight. So it was great.
Yeah. Amazing, great questions, and we will do this again soon. So hope you have a wonderful evening. Thank you again. It's been a pleasure to be with you. We'll talk to you soon.